So I think that, first of all, welcome to both of you. I think that the topic for our panel is very interesting because we're talking about alternative financing for entrepreneurs. What do we mean by alternative? What's there? What's available? Egla, could you shed some light?
Hi, everybody. I hate that, Lilimba, I love and hate that she was like, we'll give you money. Now I'm like, didn't bring my checkbook, I'm sorry. But really excited to be here. Just to reintroduce myself really quickly. Egla Ntumba from MsFiT Ventures. So what we do, provide working capital to SMEs. So traditional businesses, not tech first kind of startups as they're termed. So very specific what we do. The kinds of funding that is there and available. Typically, if you think about the capital structure of a small business, you have equity, which is, other people's money that they give you for a share in your business. You have debt that you can get. And typically for a small business, that comes in the form of either trade finance. So the little bit of extra wiggle room that your supplier will give you to say, instead of paying in 30 days, maybe paying 60 days. That little bit, it's actually kind of debt as well. That's trade finance. And then you have equity debt. You also have grant funding that can also be involved in there. Grant funding a lot of the time is considered as free money. The reason why I use air quotes is because they don't usually expect you to pay back grants, but there are obviously recoverable grants that you do have to pay back. But usually they don't expect you to pay back grants, but there is a little hidden price tag on it because you have to do a lot of internal work for the team to have the structure to be able to do the reporting metrics and things like that to meet the requirement for the grant funding. And we became aware of this when one of the startups we had funded in sort of the VC Live, in my previous life when I was a VC, and they got off grants and they had a lot of requirements for the reporting that they had to meet. So these are the kinds of financing usually available to entrepreneurs. And this is when you want to take other people's money. Otherwise, if you put your own money, it really falls under equity because you're really investing into your own business. Anyway.
Fantastic. Anybody learn something new from that? Okay, great. Martin, when we're talking about investment readiness, what are we talking about and how many programs does Fetola offer people? Yeah.
If this is being recorded, I hope my CEO is going to listen very clearly. So yes, my name is Martin Matshego. I run investment readiness at Fetola. So for those who don't know Fetola, or Fetola, however you should pronounce it, it is an accelerator that runs nationwide programs. We accelerate anything between 200 to 500 entrepreneurs each year. And we run them nationwide, and we have a 90% success rate of entrepreneurs still being active after 5 years. Oh. So if you know what the national average is, we are 9 times that. So yes, you can.
So
clap.
that means in 5 years, only 10% of entrepreneurs survive. So if they've got 90%, they're doing well. Please give them a round of applause.
Yes. Again, I hope my CEO is watching. So yes, so effectively in the investment readiness department, we specialize in the scaling of the businesses. So we deploy different financial instruments to the entrepreneurs for whatever needs that they have. Now, on the point of the investment readiness, it's usually clarifying 3 main points. One, there's usually a mismatch between what the entrepreneur is saying and what the investor wants to hear, and also what the investor is saying and what the entrepreneur wants to hear. So clarifying that. 2, there's a market opportunity that needs to be taken on. The clarification and the ability to articulate that market opportunity is quite often where the whole thing falls apart. You wake up every day, you run your business, you live and breathe it, yet your ability to then talk about it kind of falls. So we then work on the ability to articulate what is the opportunity that you have at hand and what do you need. Then lastly is the financial planning element of it. What happens after? So it's one thing to need the funding, it's another thing to say what happens once you have the funding. And all of that then tends to get people in a mess People go out looking for funding with ridiculous terms and terms and terms, and then once they're supposed to deliver, all of a sudden the terms were unrealistic. So we then help the entrepreneurs to manage that. Have I answered your question?
Yes, yes. So when you are looking at an entrepreneur, to go a little bit deeper for our audience, in your due diligence and supporting them to becoming investment ready, where do you feel the big potholes are in the entrepreneurs you look at? Where are the missing pieces that you support them get ready on?
So in recent years, we have taken the role of both the developer and the funder.
Okay.
So we're currently deploying around about 300 million in different financing instruments to the entrepreneurs as well as grant funds. And that is where we then realize that, okay, again, it's the entrepreneur's business. Mm-hmm. You did not borrow it. You did not pick it up on the floor. You did not buy it from someone, I hope. So for some reason, when it comes to them talking about it and trying to convince, so investment readiness is the ability to convince an investor that your business is worthy. So when it comes to them having to convince someone, the ability then lacks. So then it's the empowerment of the entrepreneur to provide exactly what the investor wants. So if you're unable to answer, what do you need? Which is where it falls quite often. What do you need? I need capital to grow my business. No. What do you need? You actually need equipment. Okay, now we have a starting point. See, what do you need? I need to grow my business. No, what do you need? I have more sales that I can cater for. Okay, so you need more inventory. So that is where you can then tailor the investment product. So quite often the sentiment is there is no money.
Yeah.
Ladies and gentlemen, if you need to take away anything from what is going to be said on this platform today, is that there is more money than there are entrepreneurs.
Did you hear that? You heard it first at Pranary. There is more money than there are entrepreneurs.
They hold conferences in this very same building every year to talk about how to fund entrepreneurs. That's how much funding is out there. But the ability to access it is where it falls apart. So we then help them to try and create the exact conversation that they need to have with the investor. Do you need working capital? Do you need asset finance? Do you need a grant? By the way, we have a grant fund open. It's called the Nedbank Green Economy Fund, cheap plug. But yes, you tailor the product based on what do you need. If you are unable to answer what you need, an investor will not be able to give you what you need.
That's such a good point. I just want to add on to some of the points Martin made, especially because what we found, myself and Jill, when I say we, I'm talking about myself and Jill. She's in the audience. Say hi, Jill. She's my co-founder. So what we found is as we are talking to more entrepreneurs and trying to explain to them what we're doing in terms of providing working capital financing, we found that a lot of entrepreneurs understand venture capital because venture capital on the continent is quite loud. Venture capital is really good at being seen and things like that. But then we found that entrepreneurs don't understand, to the point that Martin made, that if you have an order, one of the founders we're speaking to right now has an order. She needs 100,000 bottles to be able to supply to one of the large retailers here in South Africa. She can only afford sort of about 40 or 60. That extra 40 or 60, she needs capital for, right? Now, to the point Martin made, if you don't know that you can get somebody to finance that, then you're not going to look for that financing. Then maybe you're not going to fill that demand, and you're not going to be able to grow and be sort of a trusted supplier to that particular customer. So understanding what is your actual need, but also just getting a little bit of financial literacy, we found is a real problem for entrepreneurs as well.
So, Egla, do you find then that putting Martin on the spot, investment readiness programs are helpful, or are we still also speaking different languages between the programs and what you're trying to do as investors?
I found that investor readiness programs that actually connect the founders with actual investors on the ground are really useful. And I'm sure that's why Martin can sit here and boast that 90% of his businesses succeed. And for the ones of you who don't know the stats, 70% of businesses in South Africa fail in their first 5 years. 90% of theirs are able to succeed. That's a huge accomplishment. So, you know, being able to not only sort of have the program and tell the entrepreneur the story, but matching them with entrepreneurs on the ground to maybe have a session and come and speak to the founders and say, what do we look for? What is our process? Giving the entrepreneur that real life exposure. And also, I've even seen some other programs where they actually bring in investors for a mock interview, where the founder is then prepared before they go out to the market to speak to investors. So that's a really, really useful one. So I think that a lot of programs are realizing this benefit and are starting to tailor their offering towards that. So I do think that there is a clear need for this kind of programming on the continent, and that they are actually doing a really, really good job, as you can tell by the numbers that they actually have, like Martin.
And Egla, when you are assessing entrepreneurs, where are you seeing the biggest gaps for how they're presenting themselves, what their businesses are looking like? Where are the gaps? Like, what holes can they fill before they come to see you?
Honestly, tailoring your business for the kind of funding that you need. So knowing, back to that financial literacy point that I made earlier, understanding that if your business is a technology-first business, right? And that you're going to want to take outside financing. Understanding that because that's the journey that you've chosen to take, then tailoring your business to be a high growth, almost growth at all costs business, that's what you need to solve for. That needs to be your North Star, right? And you just need to be focused on that. Because as a venture capital investor, all they want to see is growth in revenue. That's it. They don't care that you're going to be profitable. They do care. Now they do care a little bit. But it's a little bit of a longer journey, right? So you can prove that out in 5-7 years. That's okay. They don't necessarily need you to be profitable tomorrow. But if you're speaking to me as a debt investor, I need to see revenue. I need to see an EBITDA margin. I need to see that you're able to create the cash flow to pay me back. So I'm not going to buy a promise. I mean, something that Jill always says is that with venture capital, you're sort of funding the future and the potential in the future. With debt, we're looking backwards at what you've done and achieved to believe that you can replicate that going forward. So understanding these kinds of nuances of the kind of funding that you need is really important, because if you're coming for debt, you need to be working towards becoming profitable as soon as possible. If you're coming for equity, then that's a different story. You know, so that's the biggest gap that I've found, understanding the kind of financing you need and sort of tailoring your business towards that. Now, I'm not saying that these are exclusive also. I don't want you to misunderstand me. Yeah. I don't want you to think that if you are a tech-first business and you're raising equity financing, that you can't get debt. Because think about it this way. Think about your business as like a pizza with, like 8 slices of your pizza. The slices are your equity, okay? Now, think about the fact that in order for you to maybe pay some of your suppliers, maybe you need 100,000 rand, right? Finance, so you can just pay your suppliers so you have more bottles to meet an order. Why would you take a whole pizza slice from your business and sell it to Martin for the 100,000 rands? Now Martin becomes a full partner in your business for a long time, when you can just get financing from Egla, repay it in 3 months, and be done with me. I'm not saying you should. This is not financial advice. But what I'm trying to illustrate is that don't use the wrong kind of funding for the wrong thing. Correct. Don't sell a slice of pizza for something that you could solve with something else. Do you see what I'm saying? That's what I'm trying to say. Okay.
Don't sell your slice of pizza if all you needed was salt from the neighbor.
Yes, exactly.
Just borrow, put it back. And I think that's an important point that you raise. It is noting, what do I need the financing for? To Martin's point. And half the time, entrepreneurs don't know this, and then you match the different finance to a different need. If it's a short-term thing, try and look for shorter-term solutions that can fit that. If it's longer term and you're thinking about scale, then definitely sell your slice of pizza, because, you know, it's better to have 2 slices of pizza in $100 million business than to have just the whole pizza and it's worth 10 rands, right? Yeah. Yep. Martin, tell us about grant funding. We want the money. How's that working? What do we do?
Yeah.
Okay, so, all right, let's drop the free money thing with grant funding.
Yeah.
It's never that. So we administrate around 30 million in grant funds every year, and think of your own time as money.
Yep.
Right? Especially if you're a consultant or you've ever done consulting work, you have an hourly rate.
Mm-hmm.
Right? The amount of hours that are going to go into your reporting for a grant, convert that into money and then look at how much you're spending. That is a cost to your business.
Yeah.
The amount of time that you have to dedicate in order to, to fulfill a funder's reporting needs can actually be more than an interest rate on a loan.
Yeah.
So, have a look at what your funder requires. That's one. 2, usually a grant funder has a specific objective. Their objective is they want to serve underprivileged schools. You are a baker. You want your bread to be in retail stores. Now you got a grant that says go give bread to underprivileged kids. You will do it for the next 3 years because they give you a grant. When the 3 years lapses, you have lost market share on the retail side because you went that direction. And you went that direction with little to no margin, little to no brand visibility, because you got what? Free money. Now your business is languishing, you do not have future prospects in the business, all because of a grant. So grants do have a devastating effect on a business. There's mission drift, there's cost of reporting. There's also organizational structure, as she mentioned. You will have to change and tweak who runs your business, how it does business, the likes. Then once the grant ends, what happens to your business? Do not chase grants. Do not chase grants. Debt is the easiest form of funding to get. But the unfortunate part is it is as a direct consequence of sales. Make money. Make money. If you are not making money, you will not have grant funding available to you. You will not have debt available to you. The whole wide variety of instruments that exist out there, except for crowdfunding, because you need to be a scammer. The whole spectrum of funding will be limited to you if you are unable to generate sales. So the first step is make money.
Questions, I guess, because we've hit a number of nuggets here. Any questions from the crowd?
How do I know when a business is ready for getting external funding? Like a business, obviously, there's a point where, well, hopefully, when you start that, you're now grinding and grinding. You selling buns in the road. So how many buns do you need to sell before you, like, okay, I can now take on funding in whichever way? When am I ready to get funding to be able to, instead of selling 20 buns, I can now sell 5 billion buns?
That's a really good question. And honestly, in my experience, your business will tell you. So I think I want us to the point that Martin made, I want us to decouple the fact that being a successful entrepreneur equals raising money. That's not true, right? You can run an incredibly successful business by just bootstrapping, reinvesting your profits, investing your personal money, never need to take money from anybody else, right? This is possible. So your business will tell you, if you're selling 20 buns of bread and you're creating a profit and you're running well, you can do that until, you know, maybe you get a client that then requires you to start providing them 100 buns within that same amount of time. And then the only way for you to be able to meet that demand is to get a little bit of extra funding. So then your business will tell you that this is the right time. You know, I need a little bit of a kicker. So don't just go raise funding because it's the fashionable thing to do. Because at the end of the day, whatever funding you raise, you have to pay it back. Of course, with the grants, as Martin has said, you pay it back with your time. With equity and things like that, the investors want to be able to exit and make a 10-time return on your business. With debt, you actually just have to pay back with the capital and the interest. So before you subject your business and yourself to that, make sure that the business actually needs it. If you don't need to take money from people and you just think, you know, it would really be nice for me to do 1,000 buns next month. Okay, but do you have the demands, the customers to meet that? Maybe not. And also, starting off on your own with your own money can help you prove out if your solution actually has a market. Because sometimes, I've heard somebody say, you know, sometimes there's a gap, but is there a market in the gap? And really what that means is that you might think that, I don't know, like installing flying drones on top of this like little canal is like a really good idea. Fine, whatever. That's a market because no one else is doing it. Do you see drones flying there? No. But is there a market in that gap? Who's going to pay you to just have drones flying around here for no reason? No one. So there's no market, there's no demand, right, in the gap that you found. So actually starting on your own and just proving out that there is a product, there is a market, people are willing to part with money to buy my service, then you can scale, you know? So that's what I would advise.
There's another question there.
So my question is rather on the tech kind of business. So currently, one of the areas where there is a gap is SaaS products. That is software as a solution, right? Almost everything is still down here in America and Western countries. They actually have, met that demand. But that problem, the problem with that kind of business, setting up an application for a service, is that you need to have the application. You can't just have an application for a service and try to market it without having the application itself. So my question rather would be to you, what would you recommend to start off with? Later on, to scale up the business, I might need funding, equity-based, but what would you recommend for that starting position? Because I'm sure you do have a couple of lists for debt funding where you say, have you run 6 months or something like that? But I don't have even those 6 months. I just have this idea. This is the app. I might have a sample of what it does, but not really the app that will run the whole thing. What would you recommend with such a business?
So with validating a tech business, crowdfunding is the best way for you to gauge whether or not there's a market for what you're doing. Because you are getting real-time insights as to whether or not people believe in the vision. So, because you're selling a dream, you can't get debt because you can't pay it back in hopes and dreams and prayers. So, it has to be money that comes from sources that are patient. So you'll have DFIs that exist, so your IDCs and development bank essays who might be willing to buy in on a dream. But if you want proof that once deployed, this thing has people who will use it, crowdsource. So put it somewhere on a platform, talk to people, talk to friends, family, whoever else is in your nearest vicinity, and say, I am building this thing. come along with me on this vision. Whether they're giving it to you as a soft loan to you or whatever, if they are willing to part with cash from their pockets, then you have proof that what you're doing will have life. That's a starting point.
I absolutely love that. Absolutely love that. And I think the sooner you do that, the better for your journey, so that you don't go down the field developing this big app that then nobody ever uses.
Very good points. I think with the crowdfunding thing, that is definitely your first port of call. Because unfortunately, on the continent, the reality is that people don't have sort of mountains of savings that they can then go and self-fund their idea on. And even if you do, maybe you don't want to blow all your life savings on this wonderful idea just until you know for sure a little bit, right? So definitely getting early sort of people in the crowd, early angel investors who back your idea and believe in what you're building is the way to start. So 2 benefits there. Number 1, they'll give you money. Number 2, if you find people that are well connected within what you're trying to build, they will give you access to their networks. They'll also introduce you to later investors down the road. We've seen so many angel investors become, hardcore evangelists for a business, and they will, send me emails and WhatsApps and say, "Have you met my entrepreneur?" They're really, really exciting. Until, I'm like, okay, fine, let's sit with the entrepreneur. Like, what's this about? So that's what angel investors bring. So being able to find those few people and converting them to evangelists who then give you money and also give you a little bit of a tech insights on how to build the product and things like that, that's really, really useful. Another way to go about it is to potentially get a co-founder who could almost buy into the business, and then you could use sort of that capital to build, or they don't have to physically buy in. They can just build the tech, so they'll be maybe the technical co-founder who builds the product without charging you for it. So that's the other option. And then, so angel investors, getting a co-founder, those are probably your options there. Yeah. Oh, but a way to build out your angel sort of network. Of course, when you're sitting down, you might be like, who do I know that has a few $100,000s to write into this business? It might not be as evident. But when you start speaking to people, start with the people around you. Just tell them all. Tell all your friends, all of your family, this is what I'm building. This is what I need. Maybe I need a co-founder. Maybe I need this amount of capital. Who do you know? And you will be surprised to find out that maybe one of your friends knows somebody who knows somebody who knows somebody at, MTN. And then they'll introduce you. So just build out in public. That's the way you build out that network.
Love it. Martin, what is the structure for your programs? How long are you spending with the entrepreneurs? Entrepreneurs are stretched. They're trying to run their business whilst getting accelerated at the same time. What's the type of structure they can look for?
So we run different programs depending on the need of the entrepreneurs. Okay. So we tend to tailor them as per whatever growth strategy that we're trying to get them to pursue. Typically, we run our programs for 18 months. Okay. So we require a very in-depth knowledge. We become very interpersonal with the entrepreneur throughout the journey in order to be able to help them navigate their world. So they get partnered with a mentor over the course of the 18 months, as well as getting access to a whole value chain of support. So we run mainly 18-month programs. We do have 12-month programs, and then all of our investment funds come with post-investment support. These can range between 6 months to 12 months, sometimes even 24 months if the deal is really complex. And so we mainly work with impact investments. So the aim isn't necessarily to generate a financial return, but to do so whilst doing good. So the cost of then the implementation and making sure that the entrepreneurs are actually achieving objectives then becomes the onus of the funder. So a whole lot of corporates currently are now converting from their CSI model into impact investing, because then you are doing good while also still achieving your tick boxes with the BEE. So be on the lookout for those. Most of the corporates currently right now are either contributing to investment funds that are doing impact investing, or they're developing their own vehicles for this purpose. So have a look at that. Also, SAVCA, the South African Venture Capital Association, has a directory on their website. So if you were saying there's no funding, just go onto SAVCA's website, go to directory. There is a list. There are 315. 315 different funders that are there. Some of them are actually using corporate funds to do impact investments. Some of them are specializing in seed funding. Some of them are doing short-term financing, the likes. The opportunities are endless. Remember what I said, if you're going to take away one thing from this panel today, is that there is more money than there are entrepreneurs.
I have a question for Martin.
What is this?
This is me putting on my founder hat. I need to know. So if I was one of the founders sitting in the crowd, I would want to know, what is the selection criteria for your businesses that you take into your programs?
So again, they vary depending on the program that we run. We do have a program that caters for entrepreneurs that are starting out, but that one is specifically focused on youth.
Okay.
So if you are over NYDA range, so
I can't squeeze in.
well, actually maybe you can. So yes, so that one we currently run it with FNB. It's called the Youth Startup Accelerator. The third version of that is getting launched in the next 2 weeks. So if you have a cousin, a friend, a niece that is interested in starting up a business or just has started up recently, then please let them know they can apply in 2 weeks' time. Then we run the Tolowana Enterprise Program with the SME Foundation. It's kind of their flagship accelerator. It's 60 businesses that are already revenue generating nationwide with a focus specifically on rural, peri-urban, women and youth. So that accelerates and tries to develop communities where they can be self-sufficient by themselves. So the entrepreneurs are then scaled to scale into other similar rural areas or townships or the likes. Then we have a circularity focus. So we run a circular economy accelerator where we take on a cohort of 60 entrepreneurs, sometimes 80, we might be taking on 100, where we teach entrepreneurs the whole concepts behind circularity. And we have found that when they embrace circularity concepts, they actually generate more of a return than normal traditional businesses. So recycling, repairing, reusing, all of those are massive cost savings that actually boost businesses' profit margin. So we run programs to that nature. But at the core, most of our programs require an entrepreneur to be revenue generating for at least 6 months.
Okay.
But we do have programs where we take on non-revenue, but it's for the youth.
Okay. I'll throw that question to you now, Egla. What is your process and what do you require? What should an entrepreneur come to you with for you to look at them?
This is why you don't ask people questions, because they turn them back to you. So the typical profile of the business that we look for, it's not tech-first businesses. So your traditional bakery store, flower shop, like I sell sauces to Pick and Pay and Spar, that kind of a business. So your traditional businesses, those are the ones we're looking for. We're looking for businesses. We found that at about 5 million rands in revenue, that's where the business can typically absorb debt. Now, this is just kind of a rule of thumb, assuming a 10% net profit margin, which means you're making about 500,000 rands in net profit. So if you're making sort of 2 million rand in revenue, but then you have that bottom line of 500,000 rand, you can still come talk to me. But we want to provide debt to businesses in a way that doesn't add pressure, because if you lend to a business that doesn't have enough net profit to pay you back, then you're adding more problems than solutions. And the funding is working capital and supply chain finance. Supply chain finance, think maybe you need to buy input materials to make your products, whatever. Maybe you have a purchase order that you need finance, like the example that I gave earlier. that kind of financing. We give facilities between 100,000 rands to 3 million rands. Did I say that the facilities are 3 to 6 months?
No.
No, the facilities are 3 to 6 months. Pure debt, we don't take equity. Typically, we invest in female-led or female-operated traditional businesses. Now, if there are only male founders, we want to see that at least some of your leadership team, your senior leadership team, has women in it, because we want to see that there is decision-making power in the hands of women. But also because female founders receive grossly less funding than the male counterparts on the continent. I mean, think 3 to 8% of funding on the continent goes to women. So we're, addressing that gap, as well as the sort of trade finance, 333 billion SME trade finance gap on the continent. So that's what we're doing. Revenue, female leadership in there, South African, we're focusing on South Africa. Yeah.
And when they come to you, they're ticking these boxes. What is your due diligence process? How long does it take? Like, what should they expect?
So you should definitely expect sort of a 4 to 6 week kind of a process, because we want to get to know you as the founder. We want to understand your business and what are your sort of normal cash flow patterns. We want to do a deep dive into your financials to understand what was historical and what we can expect going forward. We also want to understand, we deal with infrastructure heavy businesses. So we actually do a lot of site visits as well, actually going to your factory and seeing, is this machine real, and does it actually work? Do you employ the 20 people that you said you did? So actual on the ground due diligence. The way that we think about it is that SMEs have traditionally not had a framework along which they are scored in South Africa. Let me tell you something that you might not know. If you're an SME owner, so when I say SME, it's a small business. Startups are included in small business, right? If you're an SME owner and you need debt from the bank in South Africa, there is not a framework to credit score a small business. So what they do is they'll pull out your personal details. They will now go and credit score Egla and decide if Egla is creditworthy, then I will lend to MsFiT Ventures, which makes no sense. Why? My finances are not the business's finances, but that's how it works. So we understand that there are these structural problems, and that's why the way that we credit score also includes non-traditional scoring ways. So we want to look at the numbers, but we also want to establish the entrepreneur's willingness to pay. So we look at non-traditional things, like, for example, do you have a savings account somewhere? So not only requiring you to have prior debt to be able to get debt. How do you pay your utilities bills? Do you pay them on time? Like little tells like that help us to get a full rounded picture of how you pay and whether or not you're willing to pay, even though you've not maybe had the opportunity to prove that through a bank or something like that. So that's kind of how we look at it.
Thank you. Any pressing questions? I might have time for 2 questions. Yes. No, they're back.
This is for both of you. BE levels, does that factor into your decision making with funding a company?
From our perspective, Jill is like, yes, it does. Okay,
Yeah,
hold on.
It definitely does.
It does, because we want to see diversity in the teams, but it's not an exclusionary criteria. So, for example, we have certain make or break things, like if you've just never made a profit, then no. But with the BEE thing, we want to see racial diversity in the team, but if it's not yet present, we want to see steps towards that. So it's not an exclusionary, but, yeah.
So similar but different. So we don't have it cast in stone that you need to be certain BE levels. It is a priority for us to actually develop Black and African entrepreneurs in the country. But in the event that the business does not have the right level of representation, we look at the impact that it's going to the intended beneficiaries of the business's work. So if it will be primarily for, previously disadvantaged individuals, then we then base it on that. So yes.
Another one there.
My question is for you, Egla, again. If I lend money from you, what is the interest rate that I have to pay it back at?
Goodness, you can't ask that in mixed company.
That's a secret question.
That's a secret question. But again, as I said, because we have a credit scoring model that is sort of innovative and different, the way that we charge the interest is, how do I say? The way that we charge the interest is definitely in a way that is not exploitative to the business and based on your credit profile, really.
So it's differentiated by business?
Yeah, so it's differentiated by business and depending on your credit profile, and that's why we want to make sure that we fund the best, we find the best businesses that we can support, because we don't want to charge, we've heard stories of people charging sort of like 48% per annum and these kinds of things. That's not at all where we play. But we also are a commercial investor, so I don't want you to think that we'll lend at prime.
It's prime plus.
It's prime plus.
We lend at prime. we even lend at prime minus.
He also said that there is a hidden dividend on some of the grants, so,
You have to weigh both.
I just need to put it out there though. So we only fund entrepreneurs that come from our incubation programs. So we use the incubation programs as a de-risking
mechanism.
strategy in order for us to then develop capital. Except for the grants, because they're for everyone. However, for the more commercial-ish, the different types of funding instruments, we actually need them to go through our accelerators first.
One last one. Otherwise, I've got 20 other questions. Yes. There.
Hi again. So what I want to find out is there any funding for like machinery? Let's say you're starting a company with compressors, generators, and that. Also, I've heard nothing more than like 5 million. Is there anything more than that? Because if you look at compressors, in a large compressor, it's already 1 million for that. So, is there any, maybe for anyone just in general, to explain if there's those type of avenues that they can look at for plants specifically?
So you're asking if you can get debt for equipment that's more than 5 million rand?
Yeah, and if you specifically would give funding for machinery to obviously run the business,
Yeah.
Which is the primary,
Yeah, we would give funding for machinery for sure, but we wouldn't start you off at a 5 million. If kind of how you explained that there's sort of a 1 million sort of average cost per machine, then we would probably start you off at that kind of a place and then sort of scaling up. And we also have partners who do sort of co-investments along with us. One of the entrepreneurs that we're speaking to, she manufactures furniture. And she needs, aside from sort of the working capital and things like that, she needs about 20 million rand for a specific machine. So we're trying to help her to secure that. So that's how we do. So either we will lend to the entrepreneur, but we wouldn't obviously start you off at like, even though we go up to 3 million, we wouldn't start you off there. Yeah, I know. So we would start you off and then sort of go up, but then when it's too much for us, then we do have co-investment partners that we can sort of pass you on to.
I think just as a tip, you do not boil a whole bucket just to pour 1 cup of tea. So with funding, that's quite often, again, the what do you want, right? You want to get machinery in order to start doing a certain kind of service. You're not getting the whole range of equipment. You start off with one, and then you develop and prove a concept, and then you move on to the other one. So, oh, your model is you want to bulk buy so that you can lease.
Yeah, that's the model.
The core business is rental.
Yeah.
So you purchase the compressor,
Yeah.
and you should be able to show them that it's going to show you profit, and obviously you work out also the machine's lifespan and
Yeah, so it's
servicing
buy
and all
to
of that
lease.
for them to be able then to like see if there's any risk.
So if that's the case, then gauge the market interest and then value it. And then you can go to a funder and say, okay, there is an X amount of people who are looking for equipment to pay at this rate, and they will immediately start taking it on as soon as I have the equipment. That is the only way you'll be able to justify it. Otherwise, then you're going to incur storage costs, etc., etc.
Got it. Thanks. Thanks, Ed.
Last piece of advice as we wind up our session for our wonderful entrepreneurs in the room from each of you. Pearls of wisdom.
Pearls of wisdom. Now you've just raised the stakes. If this is not wisdomist, please don't, I don't think wisdomist is a real word. From my perspective, I think what I always want founders to remember is that first and foremost, you're a business owner. Don't let the term founder, startup, VC-backed, whatever fancy technology detract you from your mission. First and foremost, you're a business owner. Your business is to sell a product, get money, and make a profit. End of story.
Yeah.
You know? So, yes, this is what. And then when you operate from that first principle, then you'll make all the right decisions, right? Because you know that my business here is to make revenue and make a profit. Even if you get investors give you money, you know that you'll make the money to pay them back. You know? Even if your first idea doesn't work, you'll find a new idea that works. Because your business is to make revenue, get a profit. Okay? Yeah.
How do I follow that up? Okay, so I have a mantra that goes, ask for funding, you will get advice. Ask for advice, you will get funding. Always try your best to actually ask. If someone is your potential funder, ask them. No human being bites unless they have rabies. So, ask them. It does not hurt. They are looking for clients. It's a business transaction. It's not begging.
Yep.
You are proposing a business idea. You're proposing a business deal. Do not be afraid to present your deal. If the investor sees value in what you're presenting, then it is a valuable exchange. But always go first.
Thank you. Thank you both.